Good afternoon, everyone. It is Monday. It is well past noon. I apologize for the delay. I was having an amazing conversation with some fellow realtors and didn't realize what the time was. Anyway, because it's Monday, it means that we are ready for our weekly Monday market update. And let me get right to that because we have an interesting question that's been coming up. So just as a reminder, I'm Jennifer Tim. I am the owner of the Welcome Home Global Group with Keller Williams, and I am a real estate planner. So I'm passionate about helping you grow, protect, and transfer generational wealth through real estate across the globe. I'm a certified international property specialist as well. And the question that we've been getting recently is, are higher interest rates the reason why there are fewer home sales? Because we're definitely hearing that in the mainstream media. Well, we're going to address a couple of different factors, and then we'll get around to answering that question, which isn't a simple yes or no, as most things in life are. So starting off with our national news. Having a look at our fixed rate mortgage average 30-day. This is from Mortgage News Daily. And this was from a report last week. And good news was we're below 7%. Not as good when we look at it a year ago, where we were sitting at 5.71%. That was when everything started going up, but much better than the peak that we saw in October of last year, which was 7.37%. So you look at that and you kind of go, oh, of course, well, no wonder there are fewer sales. And yes, the rise in interest rates has definitely impacted affordability. There's only so much that every homeowner can pay in a mortgage payment. And so obviously when the interest rates are higher, your mortgage payment is going to be higher. So yes, that is definitely part of it. It is most definitely not the total story, though. The reason why the Feds decided to increase the Fed rate, which then influenced the 10-year Treasury, which then influenced the interest rates, was truly, so they said, to slow down the crazy pace of home sales that we saw the beginning of last year and the year before that, where it was absolutely out of control. And so it felt there were, 20 offers on a property before you could even put a for sale sign outside. And that was driving up the home prices dramatically with all the bidding wars that ensued. So the idea was, if the rates went up, then it would reduce the buyer demand, because then obviously you're going to eliminate some people out of their buyer pool. And then we would see more inventory coming onto the market. And then it's a supply and demand situation. If there's more supply than demand, then that should force those prices, the home prices, to go down. Well, it hasn't actually worked out that way. So let's have a look and see nationally, then in California, and then we'll go down to some of our local Southern California cities. Total existing home sales, a percent change year over year. So we do know that the number of home sales have reduced. You would think again that because home sales have decreased, that means that there's more inventory, but it's not. So the main reason why we're seeing a reduced number of sales is actually because the majority of homeowners, because a homeowner, once they sell their property, typically becomes a home buyer, there has been a reluctance from those home sellers to swap out their super low interest rates. So yes, that brings in that interest rate conversation again, but it's the sellers who don't want to give up their low interest rate and then take on a new mortgage at a much higher rate. That is a huge part of why we're seeing some of these numbers come down. So definitely there are fewer sales that have taken place year over year. Totally understand that. We look at our closed sales. Again, you can kind of see where we are. We're definitely below previous years. We've got 2019 all the way through 2023. So you can definitely see that our sales are down. And yes, they can be linked to the interest rates. But it's the compounding effect of those interest rates that have then impacted sellers' willingness to put their homes on a market to swap out the existing low mortgage rate, because How many of us refinanced during COVID and are now sitting with a super low rate? Looking across the nation, I like this. This just kind of gives us an idea. And again, put it in perspective, because this is a huge area. West is absolutely huge. And of course, we're in California. But this gives you an idea of the sales reduction. So if the West, we look at month over month, we've seen a 5.1% reduction year over year. 22.7% reduction in sales. And then for the median price, 606,500, which is a drop of 3.4%. However, if you look at the nation as a whole, the median sales price has actually gone up year to date. And that is a really important factor, because again, this is that indication that the intent of the rate increases did not necessarily translate into those home prices going down. Because of the hunkering down, because of the lack of willingness of sellers to put their homes on the market, to then take on a higher interest rate, we've ended up with so little inventory, and we're going to keep looking at those inventory numbers until that changes, and who knows when that's going to happen. But that is what's driving today's market, and that is why we're still seeing median sales prices going up even at a national level. So even though we've got reductions in some areas, those increases in other areas are definitely creating that national trend. Luxury listings sell more in the first 6 months of the year. Median price declines reflect fewer available luxury listings. We do know that many of our properties here in Southern California are in that luxury range. They are taking longer to sell. And definitely we're getting to that second half of the year where there aren't as many buyers who are out in that price range who are looking for homes. New listings. Okay, this is the big story. This is really what's driving everything. So let's have a look at these numbers. So we've got the black line is where we are currently. Compare that to the green, which is 2022, and the blue, which is 2021. Now, you can see the cycle as you go through the year. We definitely have our peaks in spring, summertime, and then we start going into the fall market, and then we hit the holidays, and all bets are off because nobody wants to move during the holidays. We are, if you look at that 57,894, that's where we are. And we, even if just in those last 3 years, we should be a lot higher than that. And we'll show you another graph which shows how much higher. If we look at pre-COVID, we should be at, especially in Southern California. But this is the big story. This is showing that we just do not have enough supply to meet the demand, even though the demand has been tempered by the higher interest rates. And I can attest to this, working with some buyers over the weekend and looking at some properties. Well, the one property, which yes, has an ocean view, and who doesn't want an ocean view property? Well, I tell you, it was back to those crazy market days of lines and lines of people just trying to get in to look at the property. And that property is going to take a lot of money to just its original condition, 1960s, mid-1960s construction. It's going to need a lot of work to bring it up to today's standard, let alone create the type of home that most people would want to live in. And boy, oh boy, there will be multiple offers, and it will without a doubt sell way above the list price because of how unique the property is with its ocean view and its location. The available single family listings, again, if we look at this number, negative 4.1% year to date, negative 7.5% year over year, and negative 50.5% from 2019, and negative 61% from 2015. This is the story of real estate in the United States, and it has been basically since 2014, where there's fewer and fewer homes on the market. New construction, yes, that index is up. Builders are starting to build again, but it's not enough to absorb the buyer demand that's there. Again, in some areas, newer construction is not really much of an option for home buyers unless, it's a tear down rebuild. And then those properties are not necessarily going to be in the price point for our first time home buyers. They're typically going to be your, a resale type person, but they're looking for that move-in experience that maybe they didn't have when they were younger, or, the couple of homes down the line. But yeah, we are, we're really in a critical situation when it comes to that. And we have seen that has reflected in the mortgage application. So this is our mortgage purchase applications index. It is obviously down. And the 7%, I like that comment there, the 7% mark seems to be the psychologically important one that kind of gives that trigger. So we do know that we're now sitting under the 7%. Hopefully we're going to stay there, although the Feds are meeting this coming week. We do expect them to increase the Fed rate, not the mortgage interest rates, by 25 basis points. And that may translate into a little jump in interest rates, but it remains to be seen whether it's going to be absorbed or it's going to respond. But we do know that more buyers will enter the market as soon as those interest rates get just that tiny bit lower, under 6%, and it's going to be, no holds barred, and everyone's going to be back in the market. Right now, we have a lot of buyers. That was evidenced over the weekend, and I spoke to a couple of agents this morning who did open houses over the weekend. They have qualified, able-bodied, anxious, motivated buyers who have the means to put in offers on properties that are, well over $1 million. So, they're there. And we just don't have enough. I didn't have enough properties to show my buyers over the weekend, unfortunately. So we're going to keep up that search. And it's taking quite a bit of effort to find the right properties for them, because they're obviously being snapped up, and not every buyer wants to be in a crazy bidding war. It's got to work for them. Of course, if you listen to the general media, they're talking about, yes, we're in a housing crisis, I would say, and as many economists have said, this is a really unhealthy market because we've got so little inventory. That is then, demand is pushing those prices up, et cetera, et cetera. The question that I've been asked by buyers is, well, what about those, delinquencies? And we're just not seeing that. It's really at a very low point right now. So the delinquency rate is this teal color, and then the 2000 to 2005 is the average. And we really are at a record low of delinquency. So buyers, if you are out there thinking you're going to pick up that bargain because it's not going to happen, homeowners have a lot of equity in their homes because of the increases in values that we've seen over the last couple of years. So even if they get themselves into a tricky situation, they have enough equity in their homes to be able to then get themselves out by putting their home on the market and getting a great market value or above market value for their homes. And that is then relieving them of that burden. So that is not a solution at all. And it's not, there's no indication that we're suddenly going to see a massive jump as we've seen like 2008. Don't have the same lending environment. Not going to happen. Definitely not going to happen. So what is happening in Southern California? Always like to start off with what some of our local mortgage lenders are offering. This is from Wells Fargo. So again, we saw that the interest rates are sitting around about 6.7%, or they were just before the start of the weekend. Wells Fargo has some amazing jumbo loan products. And yes, for almost a 1 discount point, you're sitting at 6.11%. Looking at United American, their 30-year fix, so this would be conforming, is 6.5%. Again, better than what we're seeing on that national average. And this is Movement Mortgage. Their conforming is sitting around about that 7% for a 30-year. So again, it just shows you that it is so important to shop around, figure out what your where you are by sitting down with a loan expert who can then say, okay, we've got these products which are really going to benefit you. But take the time, shop around, and of course, we're always honored to introduce you to lenders who we know can get you to the closing table within the time frame of the contracts that you are being bound by. Next, we're going to have a look at some information from Stephen Thomas and his reports on housing. He's a local economist. Every week, he puts out an update. I've got the YouTube link down below. Google Stephen Thomas, Google Housing Debrief, Google Reports on Housing. You're going to find him. He's on YouTube, Facebook, you name it. Highly recommend that you listen to him. I'm just taking just a very few number of slides out to show you some highlights. He has a lot more information. He is a data guru as a real estate agent. I follow him, and absolutely he is on the money the majority of the time. So, you know, and again, in this market, it's kind of been a little interesting for everybody, but yeah, highly recommend that you subscribe to his YouTube channel. Let's have a look. So he did share with us initially some stats that the California Association of Realtors have released. So the share of homes that sold above the asking price jumps above 50% for the first time in 11 months as competitiveness grows. So again, this goes back to so little inventory, so few homes for buyers to choose from, so bidding wars, selling above the asking price. So that, again, this takes us through the end of April, but it just shows you again that values are not going down. They are currently on the rise. So this is the number of sales above the list price. We're not talking price reductions here. We are talking list price, and this is what they sold for. And we'll look at that as well, and it's happening fast. So if you're seeing a property that's on the market and has been lingering there, if it's in the sweet point, and I'm not talking about those higher price point luxury properties, but if it's in that sweet price point, anything, honestly, these days, which is 2 million and below, it's going to sell. If it is priced for location and condition, it is going to sell, and it's going to sell fast. So June 2023 sales price to list price ratio, you're sitting June 2023 100%, and 0 at that month to month, and just under 1.3% of the year to year. So this is showing you that we're definitely, those list prices, 100% of the time, those sellers have got at least their list price, and in many cases, especially in certain markets, above that list price. Time on market. Time on market drops to the lowest in 10 months as competition heats up. Again, June 2023 in California, we're sitting at 14 days on the market. This is from the time you put the for sale sign up till the time that you have an agreement agreed to by buyers and sellers, and you're opening up escrow. And we're just 1 day over where we were a year ago. And a year ago is when those interest rates started to climb. So that's when the Fed said, let's put on the brakes, let's increase Fed rates, let's watch those mortgage rates go up. And then we're going to see that inventory is going to sit on the market longer. There'll be more choices for buyers. That'll force the sellers to bring their prices down. And yet that's not happened because the properties are flying off the shelf. 15 days is, it's just over 2 weeks. So if you need to sell your home, if there is a reason that makes sense for you to sell your home, be prepared, because if it's priced correctly for the market, location, condition, it is going to sell within 2 weeks. So be prepared for that experience. Just spoke to some brand new sellers today who happen to be agents. And yeah, there is a lot of interest in their beautiful property, and they have one of those drop dead gorgeous ocean views. It's a little further back, but you can see the sunset, and oh my gosh, it's lifestyle written all over their home. It'll be an escrow within that 15-day period. I'm very confident they priced it correctly. So Southern California, this is again from Stephen Thomas. We are that blue line. 2021 is the red line. 2022 is where we are. And we saw that dip because we were, it was gangbusters last year with everybody hitting the market and then everything going into escrow. And then it started tapering off when the interest rates went up and because of the seasonal drop off. And that's where we are now. We're sitting where, we have 51% fewer listings this year than we did last year. And if we look at COVID, there were 104% more than what we have currently. That's huge. I mean, here's 2019 way up here. Look how low we are. This is what's pushing those prices up and will continue to do so. The interest rates that we're sitting at, yes, have reduced the buyer pool, yes, have kind of shrunk it down, but there are enough buyers out there who can weather the storm of where the interest rates are now and can enter the market at that rate. Our problem is sellers who, like ourselves, refinanced during COVID and do not want to swap out their 3%. And actually, I think Stephen Thomas has a statistic out there. I think there's 85% of homeowners who have a mortgage have a rate that's 5% or lower, 85%. And yet we're talking about sixes, potentially to 7% for an interest rate. Makes a huge difference. That is why we have an inventory issue right now. Our expected market time, we're sitting still in the seller's market. Again, this was up until the end of June. But if you're under 60 days, this is a seller's market. It just depends on, how fast the market is. And what we saw with the CAR statistic of 15 days. It's really going to depend on where your property is on those price point bands and whether you're in that sweet spot or not. Where are we with Southern California distressed listings? Just like that number where it's a historic low across the nation, that's where we are in Southern California. So even though we have those high price point homes, the majority of them have enough equity so that if there's a problem, those sellers can actually get out of that situation by selling their homes, and they're going to get that market rate for sure or above market. Locally, let's have a look at some of our local cities. Dana Point, our median price of new listings, 4.6 million. Okay, so this is something that I do want to point out. Our inventory is only sitting at 48 homes, and these are single family homes in Dana Point that are currently on the market. When you have a new listing that comes on at 4.6 million, there's not a lot of buyers out there. And just because we've got the activity is so low that you just have one of these and then it's going to, look like we have some crazy numbers. Median days on market, 49. Average days on market is 98. And that's because we have this extreme. And the 4.6 is certainly not the highest price point property in Dana Point for sure. Inventory 48, as I mentioned, still a seller's market in Dana Point. Laguna Beach, median price of their new listings, and again, they may not have had too many that have come on recently, 4 million. Median days on market 70, and they currently have 117 properties on the market, and it's still a seller's market even with those luxury price point homes. San Clemente, median price of new listings just over 2 million. Median days on market 49, so we're kind of in that. We're in that seller's market for sure. And there's only 89 homes on the market. And as I say, I saw with my buyers, 6 of them over the weekend. They saw a few more. They went and checked out some of the open houses that we weren't able to get in at the time when we were mutually available. That's all. And at the end of the day, there's competition for every single one of them. Some of them are going to sit there and have been sitting there for longer than that median days on market because the sellers don't quite have the pricing correct. And buyers are not that desperate that they're going to overpay for properties. They will go in and be willing to do the bidding war to a certain extent if the value is there and they can see that there's future value in the home. Our buyers are not, they're informed, they're educated, and they're going to make sound decisions for themselves and their families. San Juan Capistrano, our median price of new listings, 1.9. Our median days on market, 35, and there's 45 homes on the market. Strong sellers market. Again, still San Juan Capistrano is going to be your most challenging market to get in. So back to our question, are higher interest rates the reason why there are fewer home sales? It was initially. It is not the only factor. It is a contributing factor. The biggest factor is we do not have enough homes on the market. That's bottom line. Do not have enough choices. It comes down to supply and demand. And I thought this was a good report to finish up with. So existing home sales are down, prices are way up. And this was a report from Real Estate News. And yes, so National Association reported that existing home sales fell in June and dropped nearly 14% year over year. But median sale prices reached a near record high. So there's kind of the information, and then the comment from NAR's chief economist, Lawrence Yoon. The latest report numbers are consistent with trends seen throughout the year. Homeowners aren't ready or willing to part ways with their houses and risk losing their record low interest rate. And the resulting inventory squeeze has stymied buyers and driven up competition and prices. Bottom line, there are simply not enough homes for sale. The market can easily absorb a doubling of inventory. And that's what we're seeing in Southern California. Until we see more inventory coming on the market, home prices are going to keep increasing. We don't have enough new home options. We don't have the land. We don't have the availability right where we are, close to the coast, for new home builds to be an option. Most of the new home builds we see are custom homes that are in the luxury price point. They're not going to make a difference. So yes, when the interest rates come down, then sellers will find it more palatable to swap out their low interest rates. They're more than likely going to end up in a higher mortgage rate bracket than what they're in now, but it's going to be more agreeable. Right now, the differential is too great, and the sellers are not interested in doing that. They'd rather hold on to their properties. And, you know, many of them have said, well, I'm actually going to hold on to this. I may want to buy a new one, but I'm going to hold on to this one, and it's going to be another investment property. And that's how they're weathering the storm at the moment. So supply and demand, we are in that forever balancing act of our demand is outstripping supply, and that's the reality of where we are. So just a reminder, as a real estate planner, we have lots of tools in our tool belt to help you with the planning, and we don't plan for the here and now over the end plan. So we want to make sure that what we're doing for you is helping you with the strategies, putting those plans in place to make sure that the end plan is what you're looking for. Had that conversation, believe it or not, with a seller over the weekend who happens to be an owner of the property that he is selling, and he just kind of missed some of the opportunities that were out there. And it was my honor to just share some little things that I recommended that he go and have a look at and do some more investigation about. And then he's selling a second home, an investment property. So 10 tools that we have to help you make sound decisions. We will have a look at your current portfolio and really analyze them based on what the current market is doing. We will give you what that impact of the interest rates is having on your portfolio properties, and then really look at your equity analysis and see if we have any suggestions, recommendations for you to make some changes so that you can make sure you're achieving the goals that you set. Our asset performance test is such a fun exercise. We're truly going to look at your investment properties and show you whether you are actually, if your properties are performing to the best of their abilities. They may be meeting your goals right now, and that's great. We want to make sure that you have access to the current information of how your asset is performing today. Give you advice on renovation and repairs. and then help you with those plans for the generational wealth building. Do you have the right trusts in place? Do you have the right plans in place to make sure that your hard work is going to benefit your beneficiaries the way you intended at the end of the day? And that kind of leads us down to number 10, our family feud prevention plan. Daily, we hear about stories of how beneficiaries end up in court because they actually don't want the property, or they don't want the property the way the property has been, left to them. I mean, a huge blessing, but for some people it ends up being a curse. And we want to help you make sure that whatever plans you have in place actually are going to be appreciated at the end of the day. And you're not really, that value is then going to end up in the court system rather than blessing your families. Always available to help you with any of your real estate questions, help you with your plans and your wealth building strategies when it comes to real estate. So honored to be here for the journey, for your wealth building journey. Any questions at all, please don't hesitate to reach out, and we look forward to giving you an update next week. You never know, it's like as the world turns. Thank you. Bye.